Well, you're absolutely right. Developed markets were preferred to emerging markets. What we've seen in the last couple of months is correlation between developed and emerging markets actually increased. That's emerging and developed markets are moving much more in sync compared to what they used to 3, 4, 5 months ago. That's pretty much in line actually with our view. And that is not that emerging markets are great, is that developed market analysts today do not take into account slower global growth rates. They do not take into account higher US dollar, higher cost of finance, and they certainly don't take into account the what I call the blowback from emerging markets back to develop. After all, about 1/3 of global demand now actually resides in emerging markets. So I think what we have seen coming into this period, developed market analysts and expectations were too high. And they still, in my view, remain too high. That softens degree of underperformance that emerging markets have suffered from. In terms of technology, my view is very simple. We don't have any cycles globally. All the cycles were eliminated or at least subdued by the central banks. When you don't have cycles, you don't have mid-cyclicals, late cyclicals, early cyclicals. The only thing you have is perception what central banks are likely to do, and that swings your sectors around quite a lot, whether it's defensive, whether it's technology sectors. Yeah, of course. A lot of people say it's a Lehman's moment or Bear Stearns moment. To have a Lehman's or Bear Stearns moment, you've got to have liquidity crisis and you have to have solvency crisis. Right now, China has neither liquidity nor solvency. If anything else, they have too much liquidity. They're not releasing that liquidity into the marketplace. But remember, their national saving rates are over 51%. So the problem China has is really capital allocation problem. And right now, it could lead you eventually to credit crisis. And we argue within 3 to 4 years, it most likely will lead China into a credit crisis. But in the meantime, China can do various things trying to delay it and also trying to make it less destructive. And the good news is that China is one of the very few countries where politics leads from the front. And the new leadership is actually moving quite rapidly, trying to ameliorate or reduce the impact of what could be the inevitable credit crisis that they must face. It's sort of reverse of India. China has a capital allocation problem, India doesn't. But China is competitive and efficient, India isn't, and that's why India is more in a stagflationary climate compared to where China is. Both problems are hard to solve, and both problems require structural changes. No, not at all. I do think that China has no alternative but to grow in a different way. There is simply, if they continue investing 48-49% of GDP in gross capital formation, the only end road on that path is Japan 1991. And unlike Japan, global economy is not going to rescue them. So the only thing you're going to end up having is a credit crisis. And the good news is that you have central leadership fully recognizing it. Now, there are various things you need to do, but primarily you must drastically reduce the saving rates across the country. And I'm not talking about consumers. I'm talking primarily about corporates and the government. And I think that's what they will try to do going forward. Now, it doesn't mean that commodities fall off completely, but I don't believe China will be the same consumer as it used to be in the past.